Good morning. Today is Wednesday, April 9th. I'm Joe Terril, president of Terril and Company, private wealth managers headquartered in St. Louis, Missouri. Due to the unprecedented market activity and the geopolitical situation, we're coming right back with another video, and we'll continue to try and come with videos maybe once a week, once every 10 days. As long as we're dealing with these unprecedented times. So with me this morning is Bill Newbold, Russ Phillips, Dave Carter, and we intend to change up our method of how we do these videos, and today do more of a roundtable discussion. I get to go first because I have seniority of everyone here, and a couple of comments that I want to make is at the end of last year and earlier this year, we became very defensive, selling things, taking gains. We felt that everything was priced for perfection, and that if anything went wrong, we would see downside in investments, and that ended up being correct. We had real nice gains for the first quarter, but we're into a quarter now where it's just wholesale selling by people to raise liquidity, and at the end of the day, we're probably year to date flat to down maybe 1 or 2%. That is the most important thing when managing funds. Right now, Bill, I'm going to ask you, year to date, what is NASDAQ, S&P, and Dow down year to date?
Yeah, so on a year to date basis, the S&P 500 is down 15%. The Dow Jones Industrial Average is down 11.5%. And the NASDAQ is down 21%. So you can see the effects that Joe is talking about as the fundamentals deteriorated in this market.
And the idea for outperformance is your cumulative rate of return. It's not your average rate of return. You must figure a 5-year cumulative rate of return. And as conservative as we have operated in the last 5 years and continue to operate, our cumulative rate of return is as good as any of these averages for people that took arguably 5 times the risk that we did. And if in fact we do this correctly, which we think we will, there's a lot of experience sitting at this table in number of years, we have plenty of liquidity in order to buy things on the cheap. And we know we're going to get that opportunity. The question is, how much lower is this market going to do? I'm going to ask you your opinion, Russ and Dave, but I'm going to say that I think before this liquidity-driven selling based upon complete uncertainty about the world economy, before this is over, I would think the NASDAQ is going to be down 30% or more, the S&P will be down 25% or more, and the Dow will be down somewhere in the 20% range. And that will destroy the rate of returns that these averages have made when they've had the good years of 21, 23, and 24. So with that said, Russ, you're 25 years in this business and pretty sharp on equities and have been for a long time. Am I out of line with my thinking? What do you think?
Well, Joe, thank you. And I think one thing that we want to continue to communicate to clients, and I'll give you my prognostications. By the way, I will put it on the record, I lost the basketball pool, so these might not be very valid. But I think the thing that you have taught us, Bill and I, over the years, and I think this is very important for our clients to understand, is about protection of your capital. What you have done, what Dave has done over the years, is as clients are continuing to take distributions from their account, which is a very key thing, right, is that you have to protect that capital. And your comment about actual dollars in a client's account versus average percentage returns, which clients hear about, it's a major difference. I sat in a meeting with you last week, 2 weeks ago, and we will probably do a video on this if I can get the professor here to do it. But you know, we talk about average returns, and while clients are taking distributions, it doesn't matter what your average return is. It matters how many dollars you have in your pocket, because that's what's going to determine what you spend on. In terms of my thoughts on the actual market, I'm expecting a rebound here at some point this week. We need a match to kind of light the oversold catalyst that is going on in the markets. Are you out of bounds with your thoughts? No. If that uncertainty in these very unprecedented times continue, it's not unforeseen that those type of returns that you just outlined could happen. Could it happen more quickly, more slowly? I think that depends on how the policies proceed. If you're pinning me to something, Joe, I'm going to say the S&P could get down to about 4,600, 4,700. That could happen very quickly. We will have very much choppiness. We will have high volatility, which we outlined. I will say this. If that does happen, the risk reward is going to get much better. You will get better reward for less risk, which has not been the case.
I want to come back in with a few comments about the economy. It is so difficult right now to get a handle on what the world economy is going to do, other than the assumption that it's got to get worse. I don't see anything in this that's going to make it better, but I want to bring up several points. I think the administration is cracking a little bit with the recent fights between Elon Musk and Navarro as Trump's advisor on these tariffs. There's complete disagreement there. But I want to point out a few things that lead me to believe this policy is wrong. One of the first things is it's based upon a dollar assumption. There is no way that Mexico can, with their population and the net worth of that country, there's no way they can buy as much from us as we buy from them. So trying to set some policy to make that happen is ridiculous, as is the case with a country like Vietnam and etc. But the more important thing that I want to bring up also is this is manufacturing trade. It doesn't count services. The United States sells the rest of the world a massive amount of computer software, witness Google, Microsoft, Meta. We sell the rest of the world a tremendous amount of banking and insurance services. We sell the world engineering services. We sell the world medical research. So to think that somehow the rest of the world isn't buying from us is completely wrong. And how and why this is ultimately going to play out, my biggest concern of why I'm a little more bearish maybe than what the three of you are, is come May, the federal government has to do its May refinancing. We have to pay off a massive amount of debt coming due, plus borrow another $750 billion. We're a major exporter of debt to the rest of the world. I believe the rest of the world is going to say, no thanks, you're being very hostile towards us, you are being ridiculous in your assumptions, let somebody else buy your debt. And I don't know who is going to refinance us, and I don't know if that's going to happen. But I think there's some high probability that it'll happen, and if it does, that is going to be the leverage that the rest of the world uses against us. So, enough said. Dave Carter, give us some thoughts.
Thank you, Joe. I'm probably the most bearish in the camp in this group, but you know, I find really interesting, and I think everybody here will second the thought, is, you know, the 10-year Treasury is now 4.36. You know, I think last time we spoke it was, you know, right around 4.05, somewhere in that area. And normally in periods of uncertainty, the market flocks to treasuries for safety. Here they're selling treasuries, and whether that's they're selling just because they have to for liquidity purposes to shore up their equity portfolios, for margin calls or whatever, or it's something, you know, something bigger where the market bond buyers are saying something about the U.S. debt issue. That I find that awfully interesting. And as far as the equity markets, you know, Delta just reported today, and they pulled their guidance, which makes perfect sense. And you know, they're going to wait until September, October to see if they can get some more.
Didn't Walmart do the same thing? I'm sorry to interrupt. Didn't Walmart do the same thing this morning?
Yes, and so managements are pulling back their guidance, and that creates uncertainty. But they also hope, you know, they have 3/4 of the year to counter their uncertainty and to make their numbers. And as time goes on, that uncertainty continues, their guidance and their confidence weakens, so they're going to all of a sudden come back and say 2026, well, we don't have any confidence in 2026 if the current policies remain in place. And so that is, in my mind, the catalyst that takes the markets lower in the second half of the year.
Can I make one comment, Joe?
Go right ahead.
One of the things that I would like to communicate to our clients is our value bias. And the reason I mention that, there was a period from 2000 to 2006 that most people remember where value stocks outperformed. We could have another situation developing that is like that, where the Mag 7 stocks that we've talked about on many different occasions cause the stock market averages to be flat to down, but underneath the hood of the market, there are a subset of stocks, value-oriented stocks, that continue to outperform.
Well, our goal for our clients is, with the massive amount of liquidity we have, we're ballpark 20% in stocks, 80% in liquidity, will be to get those portfolios back up, maybe closer to 50% in stocks when we get the opportunity and when some of this unprecedented cloudiness or whatever you want to call it, I just don't think you can step in front of a freight train right now and assume that this is all over with, or assume that you know how all this is going to work out. Bill, I want you've been around a long time, you and I have known each other for a long time, you've been with the company now 8 or 9 months. What do you think of what's happening right now? What would you expect?
Thanks, Joe. Well, I think, you know, the great thing about our team is the maturity and discipline that we have. And I think the overlying theme that all four of us have communicated is uncertainty. And you really don't know the rules of engagement. As Joe mentioned, The tariff methodology is really hard to apply to each country. They're all unique and different in size, populations, and GDP. So that's going to be a very difficult equation. And as David mentioned, Delta Airlines and Walmart have pulled their guidance. And last week David mentioned that if you're running GM, you're really trying to get your hand around everything at the company, the supply chain, how you're going to market with the customers, what your pricing is going to be. So I think what Joe and all of us are saying is that the rules of engagement right now are very difficult to understand. And so we're going to stay very disciplined. We know that making rash and hasty decisions is a big mistake. So we'll continue being disciplined and looking to find ideas that fit our clients and portfolios. And again, we do have a value and disciplined approach. So I think the hard thing is to maintain that discipline and not get carried away by price in the market, because again, right now, until the uncertainty clears a little bit, it's better that we sit back and make sure we understand the rules before we commit any client capital.
I want to thank everyone. We're limited on time, as Brian Curtis, our producer here, is telling us. But we will be back, and as I say, we're going to have to step this up and maybe do a new video about every 7 days, 10 days.
Sure.
But Bill, thank you. Russ,
Thanks,
thank you.
Joe.
Dave, appreciate your comments. And thanks for everyone that is tuning in. Appreciate your confidence that you have in us, and we're here working.